So moving on, we'll just move on to the next one, which is the auditor's professional responsibility and liability and the concept of expectation gap. So if you have taken the code of conduct, that means you already know what is expected of an auditor, the rights he has, and basically the powers that the auditor has, and you're like, oh, this auditing is a very good career path. I can request for documents and I must be responded to and everything like that. However, in this chapter 4, we're now going to be looking at the professional responsibility and liabilities that auditors have, and also the concept of expectation gap. So, um, they are starting with a strong word that says that auditors are not infallible, right? They are humans, hence, the law cannot hold them responsible for pure error of judgment. However, the law requires them to exercise all due diligence and skills that are reasonable for an auditor to follow in the performance of his duty. This is because by law, every professional that is acting in professional capacity has a fiduciary responsibility to the company he's rendering professional service for. Being a professional just means that he's giving an opinion and his opinion will be relied on. So there's just this assumption that he's required to have adequate skill about what he's providing professional service for. This is because the auditor, if in the case of being found negligent, he will be liable for losses. Okay? So where do we start out of this from? I like to break it down. Now, what is the auditor's responsibility? From the very beginning, there is a huge gap of users of the financial statements thinking that the auditors have a responsibility to the directors. However, as our learned colleague, we understand that the auditor's responsibility is actually to the shareholders, right? The auditors have a stewardship function. That is why they are in that position. Okay? So, understanding this, we now know that statutorily under CAMA, the auditors have a duty to perform all their duties. We have talked about professional competence and due care. Competence means having the required level of skill. Due care means exercising that level of skill in the work that you are doing. So a company's auditor shall perform his duties with care, diligence, skill as reasonable in each particular circumstance. So there is no template on what due care looks like. Due care is making sure that the need of your clients is being met. Now, when a company now suffers a loss because an auditor has not discharged his duties well, and you can exactly state that this duty of care was not being followed, then that auditor shall be found negligent. Okay, so um instead of starting this way, I want us to start from expectation gap. Okay. So remind me, we are going to go back to criminal and civil liability. Okay. So expectation gap. Now, expectation gap refers to the perception of the roles that the auditor have versus the roles he actually is supposed to be doing. The expectation of the public concerning what the roles of an auditor are and what an auditor is actually supposed to do are different. Now, before now, you would have heard of basic examples like the one I said, where we said that people believe that the auditor is responsible to directors, whereas the work that the auditor is doing is to the benefit of who? Of shareholders. Let's read some other ones. The public believes that the audit opinion amounts to a certificate that the financial statement is correct and can be relied upon for all decision-making process purpose, including decisions about takeovers, which is not correct, right? That's about due diligence reports. When there is a merger or an acquisition, it is a separate kind of um professional service that literally carries it out. So the public also believes that the auditor has a duty to prevent fraud and error, whereas prevention of fraud and error is a secondary function of the auditor. The auditor is not auditing a statement with the hopes of seeing fraud and error. If in the course of his evaluation or his audit procedures, he sees fraud and error, of course, he will draw the attention of the management to it. But it is not that he is going to audit the financial statement with that intention. Also, they said that the public assume that when they say that they've audited the financial statements, it means that they've carried out 100% tests on all transactions that happened in that accounting period, which is obviously wrong. I used to use all these banks. Only you have bought airtime like 6 times. Instead of you to buy airtime at once, you are managing money that you still spend. So imagine if the auditors come in and they have to now be checking all the transaction. Just imagine how much transaction you have in a year compared to how many millions or billions of users that they have. So the concept of audits in itself, even if audit is a higher form of assurance than a review, does not still guarantee 100% test on transactions. Okay, so we said that moving on, they said one consequence of this is that there is a large misunderstanding about the work of the auditor, and this leads to people taking legal actions against the auditor on frivolous basis, in the belief that the auditor should have prevented misstatements of the financial statements, or they could have prevented the fraud if they actually did their work, which is not the case, because the concept of audit is a evaluation of the financial information that has already been provided by these companies, right? The responsibility of preparing a financial statement always lies with management. It is a management function. Okay? So those things that we just highlighted above that we talked about are all examples of expectation gap. Now, the exam question, or where people have a bit of confusion in the exam, is where ICAN is now asking you elements of expectation gap or types of expectation gap. It is different. Where ICAN is asking you elements of expectation gap or what types of expectation gap. What are the elements of expectation gap? The first one we have is a standard gap. The second one is a performance gap, and the third one is a liability gap. So what is a standard gap? This occurs because of the perception that auditing standards are more prescriptive than they are, that auditors have a wide range of rules that they follow, and there is no personal touch. There's no touch of like professional skepticism in the work that auditors do. They just believe that auditors do not have like a mind of their own, and the work that auditors do is just based on the standard. They just want to follow the standard and do it, right? They're not putting in some form of personal skepticism, question reviewing into the work that they do, which we know that is wrong, because all of us that are here were in this industry. Okay, so the next one is performance gap. This occurs with the perception that audit work has fallen below the required standard. When you speak to like people that have been auditors for a long while, or like when you speak to like older generation, they'll say, audit has spoiled. When we were doing audits, if we look at a record like this, we can tell you if it is wrong or not. And then it is almost like, I don't understand. By what standard exactly do you mean when you say that the audit work has fallen below required standard from a certain time? The next one we have is liability gap. So this liability gap is where a lot of our examples of the issue with expectation gap stems from, where we say that it arises from the lack of understanding about the auditor's liability and who the auditor is liable to. In addition, there's a perception that the auditor has a responsibility for detecting all fraud and error when this occurs, but we know that auditors do not have a primary direct responsibility to detect what fraud and errors. Okay, now moving on. We said that a high level of expectation about what auditors should do may lead to legal actions against auditors. And if the expectation is not met, what we then see is that there is a public perception that is wrong about auditors. So it is in the interest of auditors to put in place steps to adequately do what? Close expectation gap. Right? So if you did CSME, I know CSME is out of the syllabus now, but if you did CSME, you have heard of something that we call gap analysis. So gap analysis is the difference between where a company is right now and where they want to get to. So similarly, there's like an expectation gap, what people think we are versus what we actually are. So in order to close that gap and be able to meet in the middle, there are some things that auditors have to do, the profession has to do. Okay, so respond to the problem or expectation gap varies in countries. Some countries have put in place corporate governance goals to strengthen the responsibility of directors for sound internal control and accounting system. Because the truth is that if the financial, you will do audit planning and will do audit risks. Audit risks is the risk that if a financial statement has been materially misstated, the opinion that you will get from that financial statement will be wrong, because your sample, what you are subjecting these standards to test has a fault. So of course, there's a tendency that your opinion that will be drawn out of this statement will obviously be wrong. Now, we said that what the auditor's report is addressed to the owners of the company, not to the users of the financial statements. Is another way to do what? To reduce expectation gap. So that, when you are a professional, so you do case study. In case study, you have the use of disclaimer. A disclaimer is that paragraph where you add that this financial statement is for the use of the shareholders and blah, blah, blah of this company. We will not be liable to any other user that uses this financial statement and suffers a loss. Okay? So that is a way to manage expectation on a financial statement. Also, we have that some countries like the UK allow auditors to include an additional paragraph in their audit reports after the opinion paragraph, disclaiming any liability that might arise from the use of the reports to whom it is being addressed. However, this is not currently the case in Nigeria. So you can also add this another way we can reduce expectation gap, including additional paragraph addressing or disclaiming liability. But what we do typically do in Nigeria is the disclaimer paragraph that we add to the opening statement or front cover of the report. So another thing that we can do to reduce expectation gap is communication. Communication is actually a very important point in reducing expectation gap. So you can have things like express communication or express outlined responsibilities of parties during an audit. Let the management function be known. Let the function of the auditor be known. And how can we get that? From our engagement letter. The engagement letter is a letter that is sent by the auditor to the client's company upon agreeing to enter into a contractual relationship to carry out a certain professional service. One of the things that is a very important component of your engagement letter is the scope. So the scope of the responsibilities of the management and the scope of the responsibility of the auditors are clearly outlined. Also, we have that there should be express communication among the audit committee, right? Where they understand where who is responsible for what and the position of the auditor on certain matters. It is very, very important. So that audit committee, there are representatives of your shareholders on that committee. And that's why it's very important that the audit committee is well looped in as to the roles and responsibility of the auditor. Also, we have that ICAN can also encourage or share relevant knowledge with the general public about the auditing profession, right? Because these people have this perception because they don't know enough. They don't know enough about what is required by the auditor. So if we have continuously shared information about the audit profession, it will help everybody involved, right? And then we have another one, which is increase control in the audit profession as well. And that's why you see things like ICAN telling you that even if you have passed your professional exam, you need to show 36 or 30, for in this case, you people are using the ICAN stream. So you need to show 36 years, 36 months work experience, before you're able to be inducted. And even signing off an audit report is not something that because you're a chartered accountant you can do. There are some other necessary controls that have been put in place. So all those things are responses that have been used to do what? To close the expectation gap. Okay? So exam question is what? Element of expectation gap or type of expectation gap. Exam question is how to close this expectation gap. Okay? Um So we also have that many companies now publish their audit reports. This method is good for electronic reporting, but it has implication for the auditor. It is a good practice for the auditor to check that the electronic form of the financial statements and the auditor's reports are identical to the paper copy. So that's another way to close expectation gap in this case. You too, anything that you see that your client is publishing that you signed off, go and read it and make sure that it is what you actually signed off in this case. But a strong point is actually communication on different levels, communicating with the internal stakeholders, communicating, especially informing the general public, putting in place education, proper education about the audit profession, and also increased controls. So if you see an exam question about expectation gap, it will most likely be about these things that we have listed. Um, Sorry, not sure why my screen has gone off. So I don't know if we'll have any question on expectation gap.
Hello, good evening.
Good
Um,
evening.
so my question is around this performance gap. I mean, looking at standard gap that revolves around um, people's perception around what the standard is saying, and then personal skepticism of an auditor.
Mm-hmm.
So, and then try to also point out the liability gap around expectations around what people expect around audit as a job itself. But my question is around what performance gap really involves on, right? If we're talking about falls below standard, what are we talking about in real
What are we
sense?
subjecting it to?
Yes,
Yeah,
exactly.
so like I said, the best example, this is like a public perception. And because we are in practice, we will not see what they are saying from their point of view. But the best illustration I can give is if you have ever like worked with like senior auditors, people that have practiced maybe before the use of softwares, when softwares were not selecting samples and then they had to select samples by themselves, things like that. They'll tell you that, oh, when somebody say they are like, people tell you that, when they say auditors are coming, they want to be fidgeting. They want to be fidgeting in the organization. They want everybody to be shaking that, auditors are coming. That now auditors will just come in, they are chill, they're just doing their work and everything like that. And, this is what the public is saying. It's like I said, it is an expectation gap that the public is saying about audit and the way audit has become. So it is now for us to do what we can to close the gap. So I get you when they say it has dropped in respect to what standard, but again, it looks like in respect to the standard that they have set for who auditors are supposed to look like or what audit is in itself is supposed to look like.
Got you. Thank you. Got you.
Okay, so I just wanted to do that before moving on. So now we're going to go to fraud and error. I like to do this before the liability so that you understand the liability well. Okay, so now what is fraud and what is error? All of us know what fraud is. Intentional and non-intentional. I always say that the difference between fraud and error is crime. You know how they say Indomie, the secret ingredient, Abi, Abi, what that advert? Crime is the secret ingredient that differentiates fraud from error. However, the issue with differentiating fraud from error is because to get the to get crime is to understand the intent. And intent is not a seen thing. So we're going to do past questions and you're going to see what I'm trying to say. Intent is not what you can see. You cannot see intention from like visibly. The best you can do is to check what substance over form. Abi, check the results that your action has resulted to over what you say you intended for your actions to achieve. So yeah, we know that fraud is intentional, is a deliberate act to maybe apply accounting policies, misappropriate assets, falsify records, while errors are unintentional misapplication of accounting standards, oversight, unintentional clerical mistakes, or unintentional misrepresentation of facts. Okay, so prevention and detection of error. Following this error, we now know that there are like different type of errors. So we have clerical errors, which are like um due to wrong postings. So under clerical errors, we have things like our error. Can you hear me? Have you done this?
Yes, we can hear you.
Aside from communication, I did not get the ways we could close the expectation gap. Those were the things that I that were highlighted. Corporate governance codes. One, maybe you're looking for a shorter, like summarized way. So they just explained it here. We can use corporate governance codes. Corporate governance is separating ownership from control. I'm responding to um okay Wally now. Then disclaimers or specifically saying who the audit report is addressed to. And number three, additional paragraph in the audit report, but it is only a practice in the UK. And also the auditor verifying any information that the company pushes out that was signed off by them. Okay? So you can listen to this recording and maybe make sense of it later. So we have clerical errors, things like our error of commission, omission, compensating errors. This is like a skills thing, or no, this is like a Babs thing. People that did ASWA. So basic accounting processes, but I'll just go over them so that it's not like our people are lost. So error of commission is wrongly posting either wholly or partially. For example, for example, 5,000 is paid to Microsoft for supply of window program, and the same is recorded in the cash book, while the posting ledger of Microsoft account is debited by 500. This may be due to the carelessness. So what we can see is that the reverse should have been the case, right? So it can be a wholly um wrong posting or a partial wrong posting. Error of omission is when the record was not even done at all, right? It's like it's not there. You did not it was not recorded in the trial balance, and it makes up errors that do not affect trial balance because it was not in itself recorded. Compensating errors is basically a error that like nets off. For example, Ram's account was to be debited for 500 but was credited for 500 okay, was to be debited for 5,000 but was credited. Similarly, Sita's account, which was supposed to be credited for 5,000, was now debited. These two mistakes will nullify each other and make the account look like it is balanced, but we can still see what a compensating error. Other things we have uh errors of principle, where the fundamental accounting principles are not being followed, overvaluation of closing stock, things like that. So now, where does the work of the auditor comes in? It comes in when we're talking about detecting and preventing this fraud. To get money illegally from an organization or from proprietor or from the proprietor, for frauds are committed intentionally and deliberately. If it remains undetected, it could affect the opinion of the user on the financial condition and the working result of the organization. Therefore, it's necessary for the auditors to exercise utmost care when it's detecting such fraud. It can be committed by top management or by employees. Examples of the following. So when you see things like this, it is pointers of fraud, not even error. You see misappropriation of cash, you see misappropriation of goods, you see falsifying or manipulation of accounts, you see window dressing or secret reserves. So they now went on to even explain the meaning of these things one by one. So what is misappropriation of cash? Since the owner has very limited control over receipts and payments of cash, misappropriation or falsification of cash is very common for big organizations where they record fictitious payments, they record amounts more than the actual amount that was paid. They are suppressing receipts. Like that means they're not recording everything that was actually made or recording less than the amounts that they made. There should be a strict control over receivables and payments of cash known as internal check to prevent such fraud. The auditor should check the cash book with the original record, bills, registers, invoices, vouchers, and counterfoils or receipts book, wage sheets. So, basically just having complementary support documents that confirms the status of your cash. Next one, we have misappropriation of goods. Companies handling high value goods prey like the E, this is an error, prey to this kind of misappropriation. Without proper record, it is difficult for the auditor to find out such type of fraud. We're going to do an exam question here where somebody was literally falsifying records about the goods that are available in the company. Also, we have falsification and manipulation of accounts. In order to achieve certain objective, they can just manipulate their account to look a certain way. They want to get discounts. They want not discount, they want to get bonus for high achievement, and then they just put the account at jeopardy. Then we have, so how do they falsify or manipulate record? You are inflating your expenses or your income. You are writing off you're trying to reduce your bad debts or excessive bad debts. You are overvaluing or undervaluing your closing stock because it affects your profitability. You are charging excess depreciation or charging less or charging depreciation in a way that suits what you want your profitability to reflect. Charging capital expenditure to revenue and vice versa, providing for excess or less doubtful debt, suppressing your sales and purchases, or showing fictitious sales or purchases. Yeah, so these are indicators of or falsification or manipulation of accounts. So why do people want to falsify? Okay, we have another one, window dressing. So window dressing is also known as creative accounting. It's basically trying to put your financial statements in a better way than it is. So trying to put your financial data in a better position than it is called window dressing. Some of the reasons for doing window dressing is basically to win the confidence of your shareholders. You want to have access to credit, and then they have said that, oh, your um earnings before interest and tax must be a certain figure, must be a certain percentage, and then you start to work back. Abi, you work from your answer to your figures on the FS, which is wrong. Also because they want to raise share price, they want to attract prospective partners or shareholders, or they're trying to win the confidence of shareholders, and then they start to window dress. Also, we have secret reserves where the company is keeping money. They're not showing their true position. That this one is like, maybe the company already has like before, like you came in as the director, the company has like 100 million in debts, right? And in that year, you were able to make profit of 20 million. Like you took them out of, so you made 120 million because you're able to close off the loss and the 20 million on the profit that you have now made. But what you have now done is to reflect a 40 million loss, right? Saving about 80 million in this case, because you're like, oh, they will still be grateful that I made money. So having secret reserves, because you want to reduce your tax liability and you don't want to show the true position of the company to your shareholders. So you said it's very difficult to detect such fraud since this fraud are committed by people in the organization who are like top managers and they understand the both legs of these transactions. So basically, the auditor must be vigilant in making inquiries to ascertain the true position. So I want to show us something. Um, um, okay. So an exam question would be state history now. Let me look for the yeah. So when it comes to exam questions, they will ask you that what procedure should the auditor carry out when he detects an error or fraud? And I just want this to load. There are about 6 steps.
Yes, we can.
Yes.
Yes. Yeah, so a direct exam question that you will see is what the auditor's procedures are when a fraud and error is suspected. So when a fraud and error is suspected, the first thing the auditor needs to do is to identify the extent and the possible impact of the fraud or the error on the financial statements. Then next, he's supposed to consider the impact on other areas of the audit. He will now proceed to have a conversation with management about the fraud or the error. Then he will consider the impact on his audit reports to the shareholders. Okay, this fraud or this error that I have seen, how does it make me to qualify my statement? Am I adding an additional paragraph because of what I have now seen and all of that? Then we have that the auditor should consider whether there are any requirement to report to appropriate authorities. And this comes from NOCLA, non-compliance with laws and regulation. If you are auditing a client and you see things like money laundering, human trafficking, child trafficking, treason, supporting terrorism, you don't ask the clients before you go and report, because as a professional accountant, you have a statutory duty to report every non-compliance with laws and regulation. Then the sixth one is the auditor should determine the actions that the management should take. Are they going to need to edit the books because of that? Or what exactly are they going to have to change or make adjustment correction journals to what they've posted? So these are the 6 auditors procedures where fraud and error is being what suspected. Okay, so just hold this one that I've said in one corner of your hearts. Okay, just want to see what is being shared. So I'm back to our material, right? Is that what you can see? Okay.
Yes.
So we can see
Okay.
the material, yes.
Yeah. So we're back to that's basically the way fraud and errors question will be asked. They will ask you like the difference between fraud and error. I've not even really seen them asking the types of errors in this case, but we're going to see exam questions where they will ask you what the auditor's procedures should look like in the event of fraud and error, and that is what I've shown you. But like the thing about AAA is, even in the last diet, AAA was one of the most failed courses. Yes. And people will be like, but there's SFM. Why are people passing SFM and failing AAA? Now, AAA is not a course that is starting from AAA. From your skills audit and assurance, they've asked you what is questions, where they will ask you what is skills, what is audit planning. When you get to AAA, it is serious business. It is like a senior auditor sitting down with you and wanting to pick your brain, wanting to ask you the why of certain things. So it is not an exam that you cram into. You need to understand the why. Okay, so that's the reason why I said I wanted you to understand fraud and error, expectations gap before we move to the auditor's liability. Now, this auditor's liability, now you know what people perceive or people expect the auditors to do, and you are fully aware of what the auditor's direct responsibilities are. You also understand what his responsibilities are as it relates to fraud and error, how it is a secondary function, and how it is carried out in the course of his audit process, not that that is what he's going to go and look at. Okay? So, however, the concept of an auditor's liability comes in where we can directly say that this auditor was found to be negligent. Now, how is it that an auditor will be found to be negligent? We already know that every auditor has a fiduciary responsibility of due care to every client that he has. And the thing about due care is that due care is not one size fits all. Due care is just being able to meet the need of every client as the case may be. Now, before somebody will come and say, oh, I suffered a loss, the person must be able to establish that that auditor has a duty of care to them. Okay? Before the person can sue an auditor, they must be able to establish that what? That duty, that auditor has what? A duty of care to them. The general principle of negligence under common law has been made to apply to statutorily appointed auditors. The operative element is the presence of fiduciary duty. Any negligence on the part of an auditor, which any negligence on the part of an auditor being a breach of the legal duty of care shall result in a liability to the person who suffers any consequence. The auditor may be prosecuted by authorities for criminal acts and may be criminally liable if found guilty. So if an auditor is being found to be a criminal, the penalty is payment of fine or imprisonment. However, if the auditor is liable under civil law, that means he would be what? Required to pay for damages. Now, somebody is asking me, so what is the difference between under civil law or under criminal law? So let me explain the two of them to you. Now, what is civil liability? Civil liability is a claim or an offense against an individual. If I offend Olamide Michael on this score and he wants to take legal action against me, okay, it is a what? It is a civil liability. Why a criminal offense is an offense against the state. So if you are being found infringing on somebody's rights, or what you have done is against the constitution of a country or a state, like when people take the lives of people, it is not only the family of that person that is suing that person to courts in this case. The government is also suing because that person has infringed on the other person's human rights. Okay, so that is what you need to know. Now, civil liability is legal claims against the auditor for careless auditing under the law of contract or under the law of tort. Tort is a type of civil liability offense against individual, while under the law of contract is you are being found to not have obeyed or followed the contract that was outlined or the contents of the contract that the two of you signed. So a company has a contract to their external auditor to provide professional service. They can sue the auditor if the auditor is negligent in carrying out the terms of the contract. Note, in contracts, only the company can sue the auditor for a breach of contract. The contract is usually initiated by the director of the company. Other persons who are third party that want to sue the contract, e.g. banks, creditors, shareholders, do not have a contract with the auditor. Therefore, they cannot bring a legal action under law of contract. So under law of contract, which is a civil liability, is the company suing the client, the assurance firm. Okay. However, under torts is a type of civil wrong that arises where a contract law is given for the rise of damages. It is not a criminal offense, but it allows the injured party to bring to civil action to bring an action in civil law against the wrongdoer. So negligence is an aspect of torts where a person can claim under torts that this person did not carry out their duty of care to me. However, before you can now claim under torts that did not carry out their duty of care to you, there are some conditions. Number one, you must be able to establish that that auditor owes you a duty of care. So in this case, sister, we have different stakeholders of like the financial statements, but it is not all stakeholders that the auditor is responsible for. Okay. Number two, you must now see that that duty of care that he has, it must have been broken. You must be able to prove, under civil law, the participants are the plaintiff and the defendant. Under civil law, the case will tarry in court for about 6 to 12 years. Under civil law, when you are being found to be wrong, you do payment of damages. Damages is really like a monetary compensation just to cover the loss that has been incurred. So under civil law, before somebody can be found as wrong, you need to prove the balance of probability. Okay, so just to show that yes, this person actually, based on the evidences that you bring forward, so that duty of care that person had to you must be seen to have been breached. Then there must now be a loss that has arisen now or arose based off of the duty of care that the client or the assurance service broke. Okay, so these are the three things. You must owe the person a duty of care, you must outline that that duty of care has been broken, and you must have suffered a loss. Okay, so yeah, that's almost the same thing that has been outlined here. Okay. Now, under criminal law, let's go back to criminal law. Under criminal law, this is where the auditor is found to be criminally liable. Okay, this is where he does what? He accepts an appointment as an auditor under statutory provision without being qualified to act, because that is what CAMA states, and CAMA is a law of the Federation. Number two, where he's involved in fraud or falsifying of accounting documents and records. Number three, where he is guilty of insider dealing. The criminal law of many countries makes it an offense for a person with insider knowledge or price-sensitive information to use that information. Insider dealing is prohibited under IFAC and ICAN rules of professional conduct. So when there is a criminal liability, it may also arise for things like winding up of the company, tax law, money laundering. Like I said, it has to be an offense against the state. Like the state must outline what they are suing you for as an offense. Okay? So yeah, so that is criminal and civil liability. So let me just break it down. If a company give you work as an auditor and you have been found to be negligent with that work, they will sue you under law of contracts. If a shareholder of that company sees that you did not do the right thing, maybe shareholder, lender, debt, like you understand, their own creditors and everything like that, they will sue you under law of torts. Do you get? However, let's say the government wants to sue you based on the information you provided that they used to tax a company. They will sue you under criminal liability. She gets. Are we together?
Can you repeat that, please? I want to write it down.
If the company that engage you wants to sue, they will sue under law of contracts because you have a contract with that company. If other stakeholders that are not the company, like the company that is the one that has a presence, wants to sue, that means a shareholder, bank, financial institutions, or the company's lender, they will sue under law of torts. While if the government wants to sue, they will sue under criminal liability. Do you get me?
Yes, it's
Okay?
okay. Thank you, ma.
Yes. So now the second part of this of our class is where we treat past questions. Is where we do what? Where we treat past questions. So, I'll put the diets in the I'll put the diets on the chat, and then I will share my screen. So the questions. Can you see the question on
Yes,
my screen?
yes,
Okay,
yes.
so all these firms have been castigated over the years by the public whenever their clients have financial or operational crises. The potential liability of auditors have also become an important topic in recent years due to the growing complexity of business and legal environment and the increase in legal actions against auditor. One reason put forward to explain the higher number of legal actions against auditor is expectation gap. Okay, so do you also have the Pathfinder that is topic by topic? If yes, share. Okay, no problem. We'll see to that. So they are now asking us that we should explain expectation gap and describe its three elements. Easy busy, Abby. Somebody should say the three elements so that we can move on.
Standard gap, performance gap, and liability gap.
Okay. They said discuss the strategies that could assist in closing the expectation gap. Oh yeah, 10 marks.
By addressing the reports
Corporate
to
governance.
the shareholder, an
Mm.
additional and disclaimer, adding disclaimer to your report.
Mm-hmm.
Corporate
What's the
governance.
major one I said that was not in the material?
Communication.
Exactly. So from communication alone, so if you can have like 4 different points. Communicate the roles and responsibility, communicate with the audit committee, ICAN should communicate to the general public, and increase controls, right? Increase controls on in the audit profession in itself. So by the time you add everything together, you're supposed to see 10 marks. Okay. This one was not also in your material, but what is professional skepticism? Professional skepticism means having a questioning mind. Let me show you guys. I think it's here. So let me just show you. So professional, yes, you can see my screen, right? Professional skepticism. Can you see my screen?
Yes, yes.
Okay. Let me assume that you can. So it's an attitude of having a questioning mind, being alert to conditions, which may indicate possible misstatements due to errors or fraud, right? It basically encourages you to do a critical analysis or assessment of your audit evidences. So an exam question that they ask is, at what stages of your audit work do you require professional skepticism? And the answer is throughout. You don't your trust issue as an auditor is not just at the beginning. So that's why you have the engagement acceptance when evaluating the audit evidence, when forming an opinion, when deciding the nature and the extent of the procedures you want to perform when it comes to risk assessment too. So in all the stages, from when you're accepting to when you're evaluating your evidence, when you're forming your opinion, you are still required to carry out the work that you are doing with what? With a questioning mind. Are we together? Okay, so that's what they're asking us here in this question C. Then evaluate the importance of professional skepticism in the audit of financial statements. The reason why it is important is because it facilitates the appropriate exercise of judgment. It helps you to know whether or not your audit evidences have been obtained, whether you have drawn the right conclusion, and whether you have performed the right procedures. So I will send a small screenshot of this profession. It's a very small screenshot. I will send it to the group once we drop off, okay? Because somebody's about to say, but it's not there. Don't cry. I'll share it with you in the on the group. Okay, so back to our exam question. So this was a 20 marks question. So let's go to another diet. Another diet. You just tell me the page number so I can just search for it. I'm with you. What's the page number?
May 16, or what do you mean by page number?
Yeah, like just I've sent the document to you now. So on the laptop, it's taking time to search. So you can just search for May 2016. Yeah, and just tell me where that is. That's what I mean.
November 2018.
Okay. That's what we just, is that not what we just did now? Question 2.
Question 5. I thought you said question. There's another question 5.
November
Page
20.
238.
Okay. November
238.
22, 238. Okay, so is this, yeah, thank you. So this one is a direct question. Explain the term professional skepticism. 3 marks. 3 marks. Identify the stages in the audit process where you need your professional skepticism. 3 marks. Identify 3 ways in which the application of professional skepticism can be demonstrated by the auditor. This one is a direct question. They were asking them for things like, okay, how can professional skepticism be demonstrated? When they send you the PPE schedule, you should outline the questions that you have for them and the processes that you want to use to evaluate or confirm the balances that are on that PPE schedule. That's in one of the ways. The second thing is that when they tell you that some things were done out of like board resolution, you want to see evidences of the board meetings and where those resolutions were passed. Okay. Um, another one is another, like, it's just at different points in the audit. Just think about you going to audit a client and you just basically not taking their word for what it is, but doing your own evaluation and confirming the balance. Okay, they've told you that we have 25 million or we have 250 million in our bank. You want to do your bank confirmation, Abby, confirm the bank balances before asserting that yes, this is what's actually in their bank. Okay. Yeah, so that's it. So I want us to go to the new diet, the recent one. That was that May 2024, the question 4 and 5. I really like the questions. So let's do them. Just give me the number. It should be around 500 and something. So let me just try this. Yeah.
Page 564. Okay.
I did a white guess and I was correct. Okay. So please, if you have been sleeping before, everybody should wake up so that we'll read this question together. Okay? Does somebody want to read the question? If you can see my screen, let's read the question together. Question 4. Oh yeah, now somebody should read though.
Okay, can I read?
Yes, yes.
Okay, Demi Global Limited was a growth-oriented company that has been controlled by its managing director, Mr. Longe. This company sells modern sophisticated mobile smartphones directly to the public. A large number of sales agents were employed on commission basis. The mobile phones were sent to these sales agents who then sold them directly to the public. The mobile phones were supplied to the sales agent on a sale or return basis, and Demi Global Limited recognized the sale of the smartphones when it was received by the sales agent. Any
Is that
returns of the
correct?
mobile phones, sorry?
Sorry for stopping you. I just wanted to ask the class, is that correct? Is that correct? You gave somebody a
No.
phone. You gave an agent
No,
like
it's
dropship.
not correct.
You gave a dropshipper your product and you are recognizing it as sale. Oh yeah, continue now. Continue.
Okay, any returns of the mobile phones were treated as repurchases in the period concerned. The company enjoyed a tremendous growth record. The main reasons for this apparent expansion were: one, Mr. Longe falsified the sales record. He created several fictitious sales agents who were responsible for 24% of the company's revenue. Two, at the year end, Mr. Longe dispatched nearly all of his inventories of mobile phones to the sales agent and repurchased those they were wish to return after the year end. Three,
Hmm.
20% of
What
the
was
cost
the
of
impact of what he has just done? Why was he collecting the report? Why was he collecting the repurchase after the year end?
hmm,
To reduce expense.
As at year end, Abi increase profitability, then it will start the financial cycle with purchases again. Do you get?
Yes. Yes.
mhm.
Let's continue.
Okay, 20% of the cost of sales were capitalized. This was achieved by the fortification of purchase invoices with the cooperation of its suppliers. The suppliers furnished the company with invoices for non-current assets for supplied mobile smartphones. And
Hmm.
four, the
They
directors
were
of the
giving
company.
invoices as if they were selling non-current assets, but what they were supplying was mobile phones that they will still resell to agents. Oh yeah, continue.
Okay, the directors of the company enjoyed a bonus plan linked to reported profit. Executives could earn bonuses ranging from 50% to 75% of their basic salaries. The
Hmm.
directors did not query the unusually rapid growth of the company and were unaware of the fraud perpetrated by Mr. Longe. Mr. Longe spent large sum of money in creating false records and bribing accomplices in order to conceal the fraud from the internal audit department. He made efforts to cover up the illicit activities and precluded the auditor from corroborating sales with independent third parties and from examining the service contracts of the directors or discussing the affairs of the company with the sales agents. The external auditor was sued by a bank that had granted loan to Demi Global Limited on the basis of interim financial statements. This financial statement had been reviewed by the auditor and a review report issued. Required: A. Discuss the extent to which an auditor is responsible for detecting fraud and error, and external auditor's procedure where fraud and error is suspected. B. Advise the auditor on strategies to close the expectation gap. C. Explain how the review report issued by the auditor on the interim financial statement differs in terms of its level of assurance from the auditor's report on the year-end financial statement. D. Evaluate the circumstance and the nature of the reports that would have been necessary for the auditor based on the activities of the managing director.
Hmm. Somebody will see this one and say, Christiana did not, what did that girl say she teach? She did not teach us all this one. Abi? But yeah, let's look at it. The first one, discuss the extent to which an auditor is responsible for fraud and error. So what did I tell you about fraud and error?
That is a secondary responsibility of the auditor to detect fraud and error. And for procedures, the auditor needs to follow some procedures before
Mm-hmm.
on how to detect these errors.
Mm-hmm.
Uh,
Okay. Then that's one part of the question. The second part is what are the procedures? 7 marks. There are 6 of the procedure. I said I will send you. I'll just do a mini screenshot and share with you after this class. You understand of those 2 things. So there are 6 of the procedures. Identify the extent of the possible impacts, consider the impact on other areas, discuss with management, discuss the findings with management, consider the impact on their audit reports, consider if there are any requirements for him to report to appropriate authorities, then determine the action that management should take, right? So um that's what they're asking in A, right? B, advise the auditors on strategies to close the expectation gap. Do we know this one? But I've done it in today's class now, right? You people should
Yes,
answer me.
Yes,
yes.
yes.
Yes, you said corporate governance.
I said, shame is me that wants to write it. But yeah, corporate governance, the use of disclaimers, communication, Abi, 5 marks. Now, explain how a review is different, like what form of assurance, chapter one, you have done chapter one and chapter two now. So what form of assurance comes from a review of a financial statement? What form of assurance come from review and what form of assurance come from audits? Let me give you a cue. Audit comes with reasonable level of assurance. So what form of assurance comes with the review?
Limited assurance.
A limited or a moderate level assurance, Abi? So if you notice, if you would have, maybe Mr. Said would have mentioned that the thing about a review is that the opinion when a review is being conducted is that the opinion is expressed in negative form. So you know in your audits you say in our opinion we have reviewed this and this and the environment is true and fair. When you do a review, the opinion is in negative form. We have evaluated the that and this of this company and we have not found anything that comes to our notice about their financial statements being untrue and blah blah blah. That is the way you communicate what your opinion in a review. Okay, so the level of assurance, the 2 marks question is a very direct question. Level of assurance that comes with a review is a limited form of assurance, and his opinion is being expressed in what? In negative form. Now, this is the D is where the question is. Evaluate the circumstance and the nature of the report that will have been necessary for the auditor based on the activities of the managing director. So what were the activities of the managing director? You will now take these activities one by one. So number one, what did the auditor do when he falsifies sales record by creating fictitious sales? What did he do? Overstatement of what? Of income. Abi? Do you get me? At year end, Mr. Longe dispatched all the inventories to the sales agent and repurchased those that wish to return at the end of the year. What did you do? Understating of stock, Abi, of closing stock. Number
Yes, ma'am.
three, 20% of the cost of sales were capitalized, and this was achieved through the falsification in cooperation with its suppliers. This is what overstating of their non-current asset as well. They were selling, buying smartphone and showing that they were buying assets. Falsification of what? Of asset figure. Next up, we see the director enjoining bonus of 50 to 75% based on reported profits. What is this? Window dressing. Abi,
Yes,
do you
ma'am.
guys get me? So they're asking you that, what did this manager, what did you do? So this one now is relating to fraud and error. Do you understand? Relating it to this manager's activity, what is the impact? So that's what I just did. So now, if you read further, they said the directors do not query the unusual growth of the company, and they were unaware of the fraud perpetrated by Mr. Longe. Mr. Longe spent large sum of money creating false record and bribing the accomplice to conceal the fraud from the internal audit department. That means that the internal audit departments were also not what aware of this fraud and what an error. He made efforts to cover the illicit activity and precluded the auditor from collaborating sales with independent third parties and examining the service contracts of the directors or discussing the affairs of the company with the sales agents. So this question is a two-in-one question. What we just did now was to evaluate these circumstances. So looking at circumstances one by one and saying what it did in nature of a fraud or an error. Then, in terms of the nature of the reports, the thing is that this question, it has different chapters inside. Now, if when we get to our audit reports, we're going to talk about the types of audit reports that we have. We have a modified audit report and we have an unmodified audit report. So, just for the course of answering this question, what the auditor should have done is to modify his audit reports with a limitation in scope. Why? They said that he precluded the auditor from collaborating with the sales and collaborating sales with the intermediate third parties, and from examining the service of the contract to directors, or from discussing affairs of the company with the sales agents. So he's supposed to qualify his statements with a limitation in scope paragraph. What is limitation in scope? Limitation in scope is being used when the auditor is unable to generate sufficient audit evidence to back up a audit or a review that has been done. I don't want to confuse you with telling you the other one, okay? When we get there, we'll cross it. But what the author should have done was to do what? Give them a report with a what? Limitation in scope, that I was not able to get the amount of evidences that I needed to be able to justify that this position of this company is true. Do you guys get me?
Is this an example of negative reports?
So for now, as at 1307, I will allow you to call it negative reports. But by the time you are done with your class, don't call it negative reports. Okay?
Okay.
That negative reports is skills language. As I called it modified reports. That's better, okay? No report is negative.
Okay.
So do you guys get me? So that's it. Now, somebody's looking at me like, this thing is easy because we are here. If it's only me in the exam, or I will not even know what I want to write. I still told them. I told the people that I was teaching, this is a 20 marks question. The 7 marks, we did life and direct in this class. Abi, the 5 marks, we did life and direct. This one is 2 marks. Don't say that because you don't know 6 marks inside 20 marks, you leave a question. ICAN is not for who no book pass. You are literally fighting for your life inside the exam hall. Okay? So, don't go there and say, you will listen to the recording. The recording will be there, Kelvin. It's always on YouTube, so they will share the link with the group. Okay? So don't say because you don't know 6 marks, you don't answer 14 marks. It's simple. Evaluate the circumstance. Even if you were not sure of what exactly to say, look at the matters one by one and talk about how it is an error or it is a fraud. Okay? So question 5. Oh yeah, let's read it. Question 5. Another person can read for us. Oh yeah.
I read.
Global Media is a company.
Okay, you can continue.
Global Media is a company listed on the Nigerian Exchange, NGX, and is a long-established media company. In the last 3 years, it's made some losses, though it is making investments in digital publishing. These investments and the company's projected sound future projects have led to a good market rating, since it was generally seen that this digital publishing is a leading edge in the media industry. Its investments have been funded through the use of reserve built over many years. However, few weeks ago, Global Media's shares were suspended, having fallen by more than the stipulated threshold by the Nigerian Exchange Group on the rumors that asset value have been significantly overstated and that the company was no longer financially viable. Your firm, as the auditors, has come under significant criticism and is considered as being negligent. Required. Evaluate the legal position of your firm. Discuss the requirements for due care. Highlight the steps and procedures that the firm could have taken to prevent such a situation from occurring.
Oh yeah. What is the legal position of a firm when they choose to be an auditor? Do they have fiduciary responsibility or not? Do they have fiduciary responsibility or not?
They do.
They do if it's a fraud. To remove themselves.
To remove them. So I don't understand you. I'm not getting what you guys are saying. Come again. They said evaluate the legal position. You know, they are the ones that were auditing global media. So from the position of your firm, they are saying that your firm is negligent. Is your firm negligent or not? That's what I'm
Yeah,
asking.
they have, because they have a fiduciary responsibility to give in opinion giving, because they gave opinion that the company, they gave a qualified
They should
opinion.
have discovered it.
Okay. So this is a 5 marks question, no. So it's not only they are that you will write to. Do you guys get what I'm saying? You have to explain the concept of fiduciary responsibility. Do you get me? You have to explain the concept of fiduciary responsibility well in this question. That according to Kama, the moment you are appointed as a company auditor, you have a fiduciary responsibility or rights of care, and you must make sure that you are competent for any job that you decide to undertake. Do you guys get me? So B, discuss the requirements for due care. What did I say about due care?
Yes.
What is the requirement for due care? Due care means that you must be able to outline the need of the company. You cannot use a generic framework to answer the requirements of every client. Do you understand? So in this case, if they said that they were putting their money somewhere, you cannot assume that yes, this is where their money was going to. Abi, you are supposed to be able to directly answer to the needs of this particular type of what of company. So when they were giving you their asset figure, what did you do to check to confirm the balances? Do you understand me? What did you do to confirm that the balances that they were giving you were correct? You get, that is you exercising due care. So if we're establishing what due care is, can we say that this company exercised due care in their audit? I said that yes. So from what I said about due care, did this company exercise due care to global media? We already established that yes, they are negligent, Abi, in terms of their legal position. Next, we'll talk about due care. Due care is knowing that this company will have different requirements, and as I must be able to follow through with the requirement of this company. So if they told you that they were using their money to buy what did they say they were using it to buy? Investments in digital publishing, Abi, and they gave you the asset balance. Did you check it? Do you understand what I'm trying to say? Hello?
Yes, ma, we do.
You guys are not answering. Okay. Highlight the steps that the company could have taken to prevent such situations from occurring. What could they have done? This one is now professional skepticism. Do you understand? The steps and procedures that they could have done is to put in place questioning mind. So what should they have done? It's not a textbook answer. It is a common sense question. So what should they have done?
Conduct the properly.
Madam
Investigation.
Christiana,
Yes.
sorry that I want to take us back a little. This required question B, discuss the requirements for due care. I really do not understand it. They're asking for requirements for due care, but you just explained that, oh, did they take cognizance of everything they were supposed to? I mean, in due care. But I really do not get it. Can you please explain?
Okay. Let me
Yes,
show
ma'am.
you
Thank you.
the let me show you the conditions for due care. The auditor must owe a duty of care to the person who suffers a loss. We just did this in this class. The duty of care must have been broken, and a loss must have arisen from that breach of the duty of care. That is what they were asking you to explain in this past question. I was relating it to the fact that yes, a duty of care was actually broken. How? When this global media, right, gave the auditor their financial statements and they saw the assets, I was talking about the specific thing that was causing an issue here. Do you guys get me now? What was done to confirm the status of the asset figure? That's what I was trying to say to further emphasize the normal duty of care that you know. Do you guys understand what I'm trying to say now?
Yes, ma'am. Thank you.
So, in terms of their duty of care, I'm telling you how they breached it. Do you guess? I'm telling you how they breached it because them too, they should have been able to pick that the asset value was overstated before the Nigerian Stock Exchange picked it because they are their auditor and they have a fiduciary responsibility to the shareholders of the company. Do you guys understand me now?
Yes, I do.
Yes.
Okay. So highlight the steps and procedure that the firm could take to prevent such situations from occurring. So I was asking you, I was saying that it's not a textbook answer. That is a common sense, is a not common sense, is a figure it out question. So you are going to look at the issues that were wrong and say that the auditor should have, although now one thing that I want you to be able to do is to give yourself grace. Audit, you see, AAA is not like all those previous courses that you do that the moment you read one chapter, you'll be able to answer questions on that chapter. AAA is like a clock. If you look at it even from the course outline, it starts from introduction and it ends with reports. To be able to answer a full AAA diet question, you need to have a full understanding of the course. You see that from even the question 4, the D was talking about audit reports, the C was in chapter 1, and everything like that. And that's why students go into the exam hall, they say, I did not teach me this one. They taught you, just that they did not teach you as per, oh, this is the way it will come out in the exam hall. And that's why you must be able to sit down in class and be able to connect the dots when different lecturers or different tutors in this case are teaching you to your own benefits. So the steps and procedures, this will make more sense when we are doing review of financial statements, where you are like, okay, under asset, what are the questions you should ask? Under this, what are the questions you should ask? But that I'm just putting it to you that you are in this case, what procedure should auditor has taken to prevent such matters from occurring? You should have double checked the assets, right? How can you give an opinion on a financial statement and you did not confirm, you did not verify, you did not do physical verification of assets, you did not do you understand? You didn't do physical verification, you did not prove the existence, you did not check the valuation. Upon what did they put figures on that their assets? So these are the kind of things that he should have done to do what? To prevent this situation from occurring. Do you guys get me?
Yes, we do.
Yes, ma'am.
Yes, ma.
Okay. Okay. So you will take November, the first diet question as your assignment. I am supposed to screenshot the professional skepticism and the steps, Abby. That's 6 steps to you. Okay? That's our agreement, right?
Yes.
Okay. So I know you have had a long day. I've also had a very long day. The floor is open for questions. If you have any questions, let me know. And in the absence of none, we'll just call it a day.
I want to ask, like the first scenario we did, the first scenario we read,
In that
you know,
question that had something percent, the ones that you were talking about window dressing, I was asking that there was one, my network was breaking. There was one that you were talking about window dressing and
Yeah.
25%, something like that. So in a case where you don't know that this one is called window dressing, this one is called that, can you just write back that scenario and write it in your own English? What is wrong with
Yes,
what?
yes. They just told you to evaluate the circumstance. So you can treat it like a case study. Do you understand? oh, why would he be him doing this means that he was committing a fraud. You understand? They just wanted you to evaluate it and be able to say that, okay, oh, this thing that this person was doing
Okay,
was
so
a
it's
fraud.
okay if I can just do it like that.
Yes. Okay. The person that was asking the other question.
Yeah, that's same question I wanted to ask. In audit question like this, when they say evaluate, that means you
Mm,
go the extra mile. You will not the answer might not really be in the case study. So
mm.
you will not relate the question as if it's a live thing, taking yourself as an auditor in the exam hall. So I guess maybe if we see a question like that, evaluate, maybe the solution is not in the scenario. That means we do it as if we are doing practical audit work. That's
Yeah, but evaluation just means that do a critical analysis. That's what evaluating means. So, I see, I always tell students, ICAN will give you 16 pages, 16 answer, like empty leaflets for answer booklets. You can't answer a 20 marks question AAA and you did not use 2.5 page. I know that this is it's not a standard. I'm not going to come here and say this is a standard. If you don't do this, you are not correct. But I have written exams. I have taught people that have written exams. What used to happen to a lot of people in AA exam? I don't know whether it's laziness, whether they want to carry the pamphlet and give back to ICAN. You are writing a question an exam, 100 marks, 5 pages, oti shetan. How? You see that they put one line question. You say you want to give one line answer, and they put 6 marks there. If something is 6 mark at a minimum 15 lines, that you did not write any that you are stressed out. 15 lines. Not 15 lines of rubbish. Every question, it is a professional stage. This is not foundation. It is a professional stage. They are saying that the moment you do they can put you on an audit engagement. That's what it means. So that's why there's a lot of responsibility on your end to understand the question. They'll tell you when you're answering a question in an exam, have two assumptions. Number one, the person that will mark this my script does not know anything. The person does not know anything about audit. Is this what I'm writing in this script that wants to make the person to know what audit is? And the second one, the person that is marking my script knows everything. The person knows what I'm trying to say. So if you understand that the person does not know anything, you are not managing ink. Abby? You're not managing ink. Write it. When they say evaluate, it is a critical analysis. But in all of this, you also have to watch your time. Don't say that, okay, Christiana said I should come and do critical analysis. You now sit down with question 1 hour. That's not how. When you get into the exam, you put a timing on every of your question. Every of your question. You can put 25 minutes and you put a 5 minutes checking the answer, checking the question time, checking the answer that I've written. Put 40 minutes, your number one. Calculate your time. The moment your time that you have allocated on a question has passed, go to the next one. Go to the next one. So those are the issues that we see. We usually need to even teach people how to answer AA because it's not looking like, what are AA teachers teaching? Because people, even in the last diet, a lot of people had issues with it and they will pass SFM. So we don't know. We don't know. So don't write like yes, you see all these summarized materials, 131 pages, because we wrote standard gap here. Imagine if they ask you standard gap, nine type of element of expectation gap, 9 marks. Is it this three line that we put here that you want to put? No. If they even ask you what's the expectation gap, I expect you to put what expectation gap is and the examples. You are a professional student. You're not in foundation. Okay? You people, it has been a long day. Thank you very much for your time.